Hi folks, Scott here, and this is the wrap for Thursday, September 5th. So you can see on this daily chart of the S&P 500 cash index, the INX, it's also known as the SPX. I believe those are identical tracking indices. If not, someone correct me. But this is the INX, and you can see the S&P right here closed down below the 50-day moving average and above a 10-day moving average. So I just ran a test in our trading room for some of our members, and it showed a slight short bias. But that was about it, and that wasn't all that interesting. So then I reran the test looking at what about when above the 10-day moving average but below the 20-day moving average. Let me turn that on for you. Okay, so see where we close below the white line? We're below the 20-day moving average, but above the yellow line, which is the 10-day moving average in the cash index. That's a fairly unusual pattern, and well above the 200-day moving average that I thought was worth showing the results for. So using Gap Trader, my back testing tool. Let me get the strategy performance report over here. There you go. It's a slight bias for gapping down in such a scenario. Historically, we've had 36 gaps down versus 30 gapping up over the past 10, 11 years. However, what is clear is a clear short bias. Shorts have an above average win rate, about 4 or 5 percentage points higher than the longs, and they've made more money. Profit factor 1.24 versus about 0.7 for the longs. So I do believe there's a clear short bias in such a scenario, and that generally is the same case for Fridays. Shorting up gaps on Fridays is generally a good thing too. And I haven't run the numbers for tomorrow, but in this current market condition, but I believe this is going to be supportive. So probably be looking more for shorting an up gap tomorrow than buying a down gap, but this certainly doesn't rule out buying a down gap. I'll rerun these numbers for our members in the morning using our MTG stop parameters just to confirm that these shorts are indeed tradable, and determine whether or not this is tradable or not. What I mean by that is if you use an intraday stop, you'll get rid of that monster loser there, and profitability all of a sudden won't be nearly as bad. So this could be still okay for buying down gaps. But there's a little nugget to think about going into tomorrow. Now today was not very exciting, but not real surprising either, because yesterday we had our second consecutive wide spread 7-day. That's the widest spread day of the past 7, and that showed up in a worksheet here. It's a Toby Crable term, and it's a good setup for fading gaps in either direction, at least under what we would call basic bullish market conditions, above a 10, above a 200-day moving average. Has 75% historical win rate using our MTG stops, and has made a bunch of money. Profit factor greater than 1 is profitable. PF of 2, for example, here means it's made twice as much as it has lost historically. And even down gaps made 64% roughly more than they had lost. So a good setup. You generally expect consolidation, at least in the morning, after a wide ranging or wide trending day. As a reminder, these are defined down here in the notes section. We also had we gapped up today. This was a neutral scenario, this up straddle, so that really was not in play. And then one risk factor that was correction. We had down gaps today. That wasn't very good either, though. On the 5th of the month, it tends to be an anomaly, a unique day. And the 10-day moving average up straddle tends to be a positive data point. So you actually have 2 positive data points for down gaps and 1 weak one there. And then gapping down between the close and the low was pretty attractive. I'm looking for 60 and 1.3. This was just a tad shy. Wasn't bad for gapping up either, which is what some of the ETFs did because of these small gap sizes. So there was really not a whole lot not to like other than this one data point here, but in my mind it was really completely countered by these 2 points here. The guides overall, I'll show them very quickly just to see, so you can see what made these up. Actually, I'm not going to do it because it could be too confusing. I'm going to spend my time instead. We were in the UCO zone though for the ES, and actually, let me show you one thing. We were gapping down below 1653.75 in the UCO zone. Small gap down, good number historically. But look at the ETFs. The ETFs actually gapped up, which you can't tell from here, but I'll show you in just one moment. They were gapping up in the UHC zone, which was just sort of a neutral setup. Still a 70% chance or more, considering the gap size, of filling. So the problem we had was we had these small gap sizes combined with the rally in the futures last night resulted in the ETFs gapping up. Can you see? I don't know if you can see that. The white dotted line there is where the spider opened. It was just above the prior close. But look at the gap on the ES. It was below the prior close. And that's because this rally over here, the last three bars rallied hard. So the 4 p.m. close was down here in a relative sense. So it put us in a situation where we had these mixed opening directions, which I generally do not like to trade. But two considerations. The data was pretty darn good. Really no weaknesses other than that one small data point I showed on the 5th of the month. And that's really such a small gap, didn't worry me. But we had good odds for gap fill in either direction. In fact, in my comments, which I'll show you, I was going to fade a gap regardless of which way it traded. So something I did today is I want you to at least think about as you finalize your own plan. A lot of people like to follow me blindly. And that's a good way to start. But you got to understand, I'm managing multiple accounts. Of different account sizes, different risk tolerances, different objectives all together for those accounts. Some are aggressive, where I'm pretty much trading any gap that's not bad. Those I tend to trade more frequently and tend to have greater volatility, but they make more money. Others I trade more infrequently, like my core account that I comment on here for our members, since I've got folks all over the world following me, and I'm going to always err on the conservative side, as my lawyers remind me to do. But I want to show you what I did this morning, but first let me show you my comments on what I said I was going to do with my core account. So I had last night's wrap comment. September gaps when closing above the 10, above the 200, but not a 10-day high close. Really favored down gaps. That was a third big positive for down gaps today. So overall, the guides are slightly positive for up or down gaps, mostly positives for fading down gaps today. And mixed factors for up gaps. And I said, due to the small opening gaps, if it is likely that it seems to be opening mixed directions and zones. If so, no trade for me. However, the ES happens to open down below 1651.75, and you sort of had to read between the lines here. There's only so much information I can type up in a timely manner. I knew that the majority of the indices in this case would be gapping down, if not all of them. So I was willing to trade in that situation, even if one or two indices were not gapping down because of that closing variance that I just talked about. But here's what I did. As soon as I realized that the ES was not going to open below that 4 p.m. closing price there, I canceled my trades in my core account just a second or two right before the markets open officially at 9:30. You can see the white line is 1652.75. That was the open today, so it missed it by about a point. However, I had trades set up in other accounts that I did not cancel. My thought being, and I got this actually, it's a simple thought, and I'm belaboring it a little bit too much, but let me just cut to the chase. It's a simple thought that a member shared with me. If you have a trade set up to trigger at 9:30 and it doesn't quite meet your minimum criteria at 9:30, what is wrong with leaving the trade set up on until it either trades at your entry criteria, which in this case was to the downside at 1651.75, or hits the first target, or at least comes close to hitting it, triggers your proximity rule or something like that. That makes a ton of sense to me. So what I've been doing a fair amount of late with pretty darn good success is just leaving the trade on in non-core accounts, because this is a little bit more aggressive trade, and getting filled. I got filled today at 1652, pretty much well, 3 ticks from the low of the day, and then it reversed. Hit my first target at 53.75 for 1 3/4 points, and that was for half the trade. And the second half of the trade, I went for the extended target at 16.56. Let me double check. I'm pretty sure it was 2 1/4 points for the extended target. And we just confirm. Yes, it depends if you round up or down, but I used 2 1/4 points today. Add it to 1653.75 makes 1656. So the only other consideration I had that you should know, so I got plus 1 3/4 points and plus 4 points for an average of about 3 points on this trade in a couple of counts. The only thing you need to know that was my consideration was that once the first target got hit at gap fill, I wasn't going to leave the rest of the trade on and risk 5 points on that part. So I tightened my stop. like I will sometimes do in my core count, but I tightened it to 2.25 points below the open. So if it was 1652.70 correction below my entry at 1652. So I was at 1649.75. Basically knowing that if price went more than 2 points beyond the open, I'd be out and I'd end up with roughly a scratch trade. It was a good position to be in, basically a free trade to the upside, because we had some good numbers for extended targets. So that's what I did today. It was an excellent trade. It's something you ought to consider. And as a member in our trading room just shared with some other members when I was explaining this trade to them, everyone should come up with their trading plan for the gap before I post my comments, and then just use me to confirm your decision, which will give you greater confidence, or maybe give you another idea. So that's what I did in some of my accounts today. Again, not my core account, but something worthy of doing when the trade is not a bad setup. And today was certainly not a bad setup, just a little bit less than ideal. All right, so there's a little food for thought. I did no range trades. There was nothing attractive today, and did no discretionary trades other than that those gap trades this morning. So a quiet day for me, and but still a good one. So there you go. That is the wrap for Thursday,